to the second panel discussion, the second and last part of the conference. And this section will talk about CBDCs and innovation in the payment space with regard to CBDCs. And we have panelists from the private sector. I'll start from my extreme right. We have Pierre Durandt, CEO and Principal Consultant at Sumbion Solutions Facilitators. Then we have Jan Pilbauer, the CEO of BankservAfrica. Andries Brink, CEO of 42 Markets Group. Then we have James Wallis, Vice President of Central Bank Engagements at Ripple. And joining us online is Pietro Grassano. Can you hear us, Pietro? Yes.
Very well. Can you hear me?
Yes, yes. Thank you.
Very good.
Pietro is the Business Solutions Director for Europe at the Algorand Foundation. Welcome.
Algorand, but that's fine.
So we'll start with James and Pietro. The original narrative of private crypto assets was that they are both a store of value and a medium of exchange. So far has private crypto proven to be a medium of exchange, and what is your vision for private crypto, CBDCs, stable coins going forward? Can they coexist in one environment?
Okay. Should I go first, Pietro, or would you like to go first? Okay.
Go ahead. I cannot see you guys. I don't have the video of the room, but I mean, so I cannot actually see you and therefore coordinate, but please go ahead and let me know when I should step in.
Okay. Firstly, it's a real pleasure to be here, and especially to be at the university where we have this, at Ripple, we have a university blockchain research initiative, and the University of Cape Town is one of the universities we work with, and Pierre, I don't know where he's hiding, we've been working very closely with Pierre. Hey, Pierre. Yeah, so to go back to the question, you know, cryptocurrencies, you know, have been around for a while now. They are used extensively as a store of value, but increasingly as a means for transfer of funds as well. So that was one of the original sort of, you know, promises of crypto was to do that. Talking from my own experience, you know, I've been with Ripple for 3 years, and you know, we have something called RippleNet, which is a cross-border payments network. We're also working on other initiatives. We have a central bank digital currency solution. But in terms of the use of crypto, XRP, which is the crypto that we tend to use, is used on a regular basis, and there's, you know, billions of dollars being transacted the whole time using that as a what we call a bridge currency. So between one you know, fiat currency and another, the network enables connectivity fiat to fiat, but also increasingly, and I would say the majority of our customers now are moving towards using crypto for cross-border. It's cheaper, it's faster, there's no need to pre-fund accounts like you have in the, you know, traditional correspondent banking model. So, you know, I think it's a little bit like, it's still early days, a bit like, I loved the internet analogy earlier, which is like, it took, you know, a long time for the internet to really take off. I think, you know, the world of digital money has been around for a while. I think a lot of consumers don't really know the difference between digital money and e-money, so that's a part of the education. But my personal view is that we'll see the coexistence between central bank digital money, commercial bank digital money, or different forms of tokenized assets within commercial banks, and crypto. I think they will coexist. Today, it's probably, you know, 5 or 6% of the money in circulation in terms of transaction volume is central bank money. The majority of, nearly all of the rest is commercial bank money, and a tiny less than 1% is crypto. I don't know what the ratios will be in the future. I think crypto will grow. I think as the regulators get their head around it and start allowing use of crypto more broadly, then that will be the trigger to grow, as well as education and more usability of the, how to actually transfer funds. I think the big question, I think central bank digital money will definitely happen. I mean, it's already happening. Congratulations to Nigeria and a few other countries. We're working on projects that are pilots prior to going live, so not proof of concepts. I think proof of concepts should be a thing of the past now. And the big question really is what happens in the middle. You know, the commercial bank sector, and whether that will be, you know, ultimately stable coins or some other form of digital money. But digitization is happening. You know, you can't turn back the clock. You can't, you know, change the future of the world. It's going to happen at some point, and there definitely will be coexistence based on rules, based on use cases, and a bunch of other things. I think I'll stop there and let Pietro jump in.
Yeah, I mean, from Algorand's perspective, I would say that I can absolutely reiterate what you were saying before me. The important thing that I think we need to be able to conceive is actually the separation of the concept of the infrastructure, where we are doing something that is a specific thing, that is the representation and exchange of value in the digital age with no double spending. This is essentially the innovation that the blockchain brings to the party. And on the other end, the aspects of what we collectively want to decide that mean of payment is. Cryptocurrencies, privately issued cryptocurrencies, can be of many forms, starting from Bitcoin and moving to utility coins, moving to meme coins. I think that in the previous session, Pierre was mentioning something similar. Of course, having a shared mean of exchange is a matter of acceptance, is a matter of a community deciding to have the access and the willingness to utilize such an infrastructure. And this is definitely happening. The cryptocurrency market, if we talk about cryptocurrencies in the traditional manner, right, the Bitcoin, Ethereum, and so on and so forth, is a couple of trillion market. So essentially it shows that there is a demand and an offer. The fact of using it as a mean of payment for a full country or a set of countries is what we are talking about here. And also we are talking about how these infrastructural elements are going to play within the private sector and the public sector. So a whole taxonomy of mean of payments can actually happen, as it is happening already today in the centralized world. When Jan was mentioning central bank money and commercial bank money in digital format, well, they exist already today. In the Eurozone, we have a e-money directive that is 20 years old. So it's before the blockchain innovation and Bitcoin. And it helps to articulate the commercial bank money in digital form with the reserves at the central bank and the forms of digital money at the central bank. The same thing is going to happen on what we believe is a superior infrastructure in terms of resiliency, in terms of ability to avoid the single point of failure problem that is imminent to centralized infrastructures, which is the blockchain. So we can easily conceive a logic where you have a central bank digital currency that is articulating itself and coexisting with commercial bank money tokens, right? Issued on blockchain infrastructure. So let's keep separate, if you want, with this type of infrastructure.
I'll move to Jan and Pierre. Maybe you can comment about why the existing payment systems need this radical change. What's not working with them?
You go first. You are better dressed and you look better.
Opinion is divided on that, Jan. I'll be controversial and say I'm not so sure that our payment systems are broken. I think that if you look at different jurisdictions, you might find more modern payment systems in place, which provides a fuller set of services. I think what we're looking at here is depending on where and what curve of modernization a country is, there might be very useful applications for a new type of payment mechanism that function in a different way, which has unique attributes, programmability, matters of that, or attributes that will make it useful to use in certain applications. I do not see it as a magic wand that is magically going to solve for us financial inclusion challenges, okay? However you wish to define that, okay? It might provide, depending on the modernization curve of a country, it might provide additional means to make the payment system accessible and maybe provide a bridge, if you like, between a cash-based economy and helping that economy to move into and provide an interoperable bridge into the digital payments channels. But I think one has to be careful in assuming that the payment system is broken. I think the payment systems, by and large, are functioning very, very well. Okay? I'm going to stop there for the moment because okay. I'm going to get myself into
well, we are the traditional players here, I guess. Yeah. So anyway, I feel I should have put a jacket on, but I knew it's going to be freezing here, so that's why I have a sweater, and I'm glad that, oh, thank you, that Pierre also had a sweater. Listen, I agree. I think the payment system in this country is working exceptionally well, and that's because of cash, right? Based on our research, 8 to 9 payments in this country are happening in cash. And I can assure you that how you guys, or all of us in this room and online, experience payments is not how majority of South Africans are experiencing payments out there. So yes, you know, if you want to buy a cup of coffee here in the waterfront, if you want to go and buy your lunch or dinner in Sandton, you have all kinds of ways how to do it, right? You tap your debit card, you use your phone, you use your watch, whatever it is. And based on my accent, you can probably tell that I am not, I wasn't born in South Africa, but I have been calling South Africa home for the last 4 years. And previously I was in Canada. And Canada is probably kind of one of the countries where you can get as cashless as possible. I never carried cash around. But here in South Africa, unfortunately, I think we, in the digital payment space, we haven't quite got it yet. The ubiquity is missing, right? So if you leave Joburg, if you leave Cape Town, if you go somewhere where it's a little bit more remote, the only guarantee to make a payment is that you carry cash with you. And then you get to the discussion with some of the countries globally, and they say, hey, you cannot think about retail CBDC as a way how you buy a cup of coffee. I agree, because I don't think it's actually what it's supposed to do. But here in South Africa, we still haven't gotten that right. When you go and talk to the spaza shop owners, they don't accept digital payments. And they don't do it for a reason, right? They don't have a guarantee that their suppliers would actually accept digital payment. So the ubiquity is missing, it's not simple enough, it's costly, all of these things when you bundle together, that's a reason why majority of South Africans, they still carry cash and pay in cash. And what we do, I know I'm the traditional kind of BankservAfrica point of view here because we process the digital payments, the 10% of the digital payments which are happening in this country. We need to do better. And for me, it's really about the channels. It's about enabling the experience in the market. And CBDC will be probably one component of that. Pierre mentioned, you know, why are all these, closed loop kind of living next to each other. There are some commercial reasons for that. But my vision for the national payment system is that these closed loop will have to start transacting with each other more easily, more freely, cheaper. And that's what we are trying to build, and we'll probably get into it. But I really feel that the national payment system, from a clearing, settlement, and all of that stuff works well. But when you step away and you stop being a payments geek and you start looking at the customer experience, we have failed South Africans because they still transact in cash. And thankfully, that's there.
Yeah. So having made my controversial statement, I think the interoperability aspect between the multitude of closed loop systems that we have today is something that can bring great advances. Why can I not, if I use my wallet that I got at Retailer 1, why can that payment not traverse the payment system if I want to use that at Retailer 2? Yes, we have our e-money position papers that's been issued also. I don't know how long ago that was. But it is about the risk management. And that is perhaps where a digital currency can make the difference in removing risk out of the system to such an extent that those interoperability objectives can be achieved easier. Okay? The risk is managed in a different way. The risk profile is different. And that might enable things to happen quicker and maybe create channels and interoperability approaches that will make it accessible to everybody out there. Okay? So the ubiquity that Jan spoke about is the difficulty for me is understanding once that you've created an instrument is how do you make sure that it can reach that last mile? The area where I am today struggling to offer my digital payment services, how would this instrument be different in that sense? And maybe that is where we have to reach out to the broader community and say, well, what is the role that our mobile network operators can play in that regard?
And now everything has to reconnect though, right? Oh, look at that, that's fast.
Grinding thought.
I think you're good.
Are we good to go?
Let them get this part. Okay. Apologies for the interruption. For those watching remotely, there's been load shedding. So Pierre, you can...
Talking to Jan's point about cash payments.
Yeah, let's sort electricity first then.
No. Let me try and pick up the thread. So what I was saying, or where I was headed with this, was that to solve the problem, you need more than an instrument, a piece of technology. You need a community that has a sense of direction in terms of what they are trying to achieve. Okay? So we can talk about it, but we're not solving I won't call it a problem. It's not a problem, it's a reality of life, is that all of the stakeholders, or most of the stakeholders that we can get put on the table today are competing with each other. Okay? So how are we going to come up with a model which says that the mobile operator who can play a magnificent role in that last mile enablement, okay, to get that spaza shop enabled, to have the technology that needs to be there, the role that the fintechs can play, which might be seen by commercial banks as being competitive. So everybody tend to dance around each other, in a sense, because you don't want to open up your game, because at the end of the day, you are there to generate a dividend for your shareholders. And that's a reality that we cannot ignore. So if we want to find a solution moving forward, we're going to have to overcome that somehow. We're going to have to put the governance structures in place that can embrace a common kind of goal. You know, we had the topic of financial inclusion. It means many different things for different people. But each one of us have got a different role to play in that. Perhaps the regulator's role is to say, it's not my job to solve it as a regulator. Maybe my role is to help get enabling infrastructure in place. Maybe the fintechs are the guys who can come up with clever ideas about products, okay, that layer off services that the banks in the interbank space provide. And for me, it's kind of hard to see how we can achieve these outcomes if we don't find a model of how we can work better together. Just saying, oh, well, there's DLT or there's a digital currency is not necessarily going to solve these problems. It can help us, but we're going to have to wrap our minds around how we're going to work together to achieve that.
Thank you, Pierre. Andries, tell us how a world with wholesale CBDCs would look like, whether it would bring about changes in the way the interbank market operates, or in the way that people carry out payments.
Yeah, that's a big question. In my world that I see, everything changes because literally when we start denominating instruments, you know, that is the fundamental of how the interbank market works. In other words, the interbank market exists so that banks can manage their risk, right? So they place with one another assets and liabilities as they have those things available and need to fund their positions. And they do that in many ways. They do that in the form of cash. That's the most basic version. But they also do that in the form of instruments, of assets and liabilities that they hold. And these instruments, of course, have payoff structures and they have valuations. So you have money market instruments and you have capital market instruments. And these instruments have different issuers. I'm a capital markets guy, so I can keep going about this. But where does it change then? The change comes when these instruments starts getting denominated in wholesale CBDC as opposed to the current digital currency. There's a lot of efficiencies to be gleaned if that can start happening right away. And I believe that will be the catalyst to actually move the market away from current cash into, let's say, blockchain cash. I'm not convinced that I like the whole CBDC moniker. To me, it's just cash because it's backed by a sovereign who issues a promise, you know, of value. And so I understand the difference, of course. The one is traded on a specific network and the other is on the current network. But I think that as we are starting to denominate more and more instruments, and as that move happens, and that move's been very, very slow. All right, so we're not seeing many native. That's not me. We're not seeing many native instruments being issued on the blockchain, if you like. In other words, we're not seeing digital assets being constructed on the blockchain. What do I mean by that? If you take a sovereign nation, they want to build a bridge, they issue a bond to do that. that bond has a time period associated with it. It's going to pay coupons to the lender. Once that instrument is issued on the ledger, in other words, you actually purchase it on the ledger acts as the verification of fact that there was a change of delivery of an instrument versus a payment. Okay, you see there's the payment piece. Once that starts happening and that instrument starts living natively, or digitally on the chain, and the verification of the existence of that instrument only exists on the chain, not in the, in the drawer filing cabinet of Straight as it does at the moment, or any sort of institution that supposedly takes care of custody at the moment, but that the custodian actually is the technology. Once that starts happening, we will see an enormous adoption of these payment networks, because as soon as the capital markets gets involved, then the whole market will follow. So that's where I think, and how does that change? Because you see at the moment, the interbank market is, in South Africa certainly, predominantly cash, in the form of cash collateral that is placed. But once these instruments start going digital, once they start existing on a distributed ledger, we will see a lot of different types of pledges and a lot more efficiency there. And I think that may change the future of banking, certainly in terms of the pricing of banking in the interbank market. So.
Thank you. James, you can add to that.
Sure. I think I agree on the wholesale side. I think there's massive efficiencies to be gained. I didn't want to sort of jump into, actually, to Pierre's point about the payment systems are working fine. I'm not sure I agree with that. I don't know the details in South Africa, but around the world, I work with central banks. There's only one per country, right? So I travel a lot. But you see a lot of discrepancies and a lot of inefficiencies and frictions around payments generally, whether it's wholesale or retail. The concept, I think, certainly the one that we like to think about is what we call the Internet of Value, right? So that is the ability to move value as easy as it is to send an email or send data across the internet. Now, I know it's a bit more complicated because you have rules and regulations around money, but that's definitely, that's, I think, what we should be aspiring for, right, is sort of virtually no cost, low friction, and instant settlement. And then as you think about the sort of retail CBDCs, I don't think it's not just about payments either. One of the things, we're working with a country called Palau, which is a very tiny country in the Pacific Ocean. They're a dollarized country. They don't have, therefore, a central bank, but they wanted to have their own currency for a whole series of different use cases. So we're working with them to issue what I think will be the first government-issued and regulated stablecoin. And they've got some really interesting use cases around that. Now, you could argue that, you could do that within a different form, but digital money allows you to do things like this P2P lending platform they're looking at. So one of the cultural things in that country is, when it's payday on a Friday, people line up round the corner to get money cash out of the ATM, and then they have a culture of lending money to friends and family for all sorts of different reasons. So they go and they drive to the next sort of town and they lend some cash. And so one of the things that they want us to build with them is a P2P lending platform. Right? So it's a very simple DeFi, distributed finance application that leverages a digital currency. So in that case, it will be a stable coin. But so I think so you can definitely pay for your coffee here, right, or anywhere around the world. But I think I'd like to think about this as a platform for new innovation as opposed to necessarily fixing the past. So I think that's the opportunity. And I think a lot of people tend to say, what problem are we trying to fix? Well, I think the problem we're trying to fix is how to innovate and actually make things a lot better, not necessarily fix a particular instrument or a particular payment type.
I would agree.
Thank you, James. Pietro, the next question is for you.
Yep.
So the conclusion of Project Coca and many other similar projects around the world meant that blockchain can indeed facilitate interbank payments on par with existing payment systems. So have any major countries launched a wholesale CBDC? And if not, why is it the case?
Well, I think that if I look, there is a little bit of echo, but fine. If we look at the CBDC tracker that Boston Consulting Group and a few other firms put together, and we just filter for wholesale, we see that there are many proof of concepts, lots of researches, a few pilots, and interesting ones, right? The Banque de France pilot in, of course, France, the France and Tunisia, the France and Singapore pilots, the Jura project between France and Switzerland, between Swiss National Bank, Banque de France, and the Bank for International Settlements. There are other cases. Probably the first pilot has been Project Jasper, launched by Bank of Canada in 2016. And then I think that, e-shekel in Israel, in terms of research, started in 2017, Delphi project in Austria, Project Helvetia in Switzerland, Coca in South Africa, Lion Rock and Itanon in Hong Kong and Thailand, and so on and so forth. And then there is another aspect that is, which is, as Pierre mentioned, the community, right? The legal acceptance of all this. So the thing works. It has shown that it works. It has shown that it can, for instance, solve lots of the technical counterparty risk issues that have been, by the way, part of the great financial crisis in 07-08, right? So there can be elements of innovation that are pretty important. And then, of course, there are resistances by vested interests that exist, right? So when I say that custody can be done in a different manner, I'm not just making friends, right? I'm saying that it can cost less, and therefore there are vested interests that will try to drag on the acceptance of the innovation. What is actually, I think, plainly demonstrated is that this is an innovation. The fact of having a robust and more resilient infrastructure for the representation and exchange of value in the digital age can be something particularly beneficial. And going back to the payment logics, if I may, there are lots of new things that can be done with, let's call it programmable money, albeit, so both in situations where the current digital payment infrastructure works, which may be the case in South Africa, and in situations where the digital payment infrastructure isn't particularly effective, like in other countries. I could mention the United States among them. And for instance, we are entering in the age of IoT devices, and IoT devices and sensors will have to give value to the data that they are giving to various parties. And how to make a seamless payment for this exchange of value, I think there is no other chance than doing it on a novel infrastructure.
Thank you, Pietro. Let's turn to retail CBCDs.
Maybe if I can just make a comment on that. I saw recently Yelland from the European Central Bank mentioned that they would only look at 5 years before they would start issuing their first central bank digital currencies, the wholesale, I think. I spoke to a gentleman from the Swedish bank the other day, similar time frames. The central bankers seem to be talking 5 years. I'm not sure about our esteemed colleague, and he's probably not allowed to say. But if let's assume 5 years is the number, And I certainly get a cringe, you know, when I hear about programmable money and what central banks intend to do with that. I'm a libertarian, so just so you know, I don't like the idea. I like the idea of private cash. I like the idea of private money. I don't like terrorists, please don't get me wrong, but I certainly like I think there's a very important role of privacy in all of this, and programmability certainly has my hair standing at an end, which is a very difficult thing to achieve, given my haircut. But you know, what I would like to say is that that doesn't stop, you know, good actors from producing exactly the same result. You know, we're seeing a lot of retail banks, a lot of sort of capital markets players starting to issue, as they should, in their role in the financial industry. They are literally just issuing what's now known as stable coins, which is also a term that I don't really particularly think is correct, but it is really a representation of their ability to create credit anyway, or to create cash as per the reserve system. And that's useful. That's becoming very useful, because it is just gleaming off the ability that we have in the blockchain, you know, and with all the fintech innovation and making it possible to have an open system. And so I say more power to them. And I would also say that the central banks are probably going to be left behind because of their, you know, reluctance to go fast, as our Nigerian colleagues have shown is possible. I agree with the go small and just start somewhere. We don't know a lot. In fact, we know very little. You know, for instance, how do you apply a monetary policy to something which is inherently perhaps opaque at times? You know, that's quite a difficult thing, a very difficult thing. But then we have new tools. We have automated market makers. We have you know, pools that can determine yield on an algorithmic basis very much quicker than any central bank governor or, you know, policy maker. Or we can have real-time inflation measurements and accordingly adjust policies. And so the benefits coming, and this is again, I'm interjecting because you asked me my view of the future question, which relates to this answer. You know, the type of tech that we can see based on the innovation needn't be stopped by wholesale not coming online. I think we've got enough going on, and once the once we see sufficient liquidity, which I don't think is too far away, you know, USDC is a how do I say this? USDC is an interesting actor in the whole liquidity play. You know, I think regional banks, I think multinational big banks with big balance sheets who've been doing that type of activity for years should take the lead there. And then once we see liquidity come through on that, the innovation will flow quite nicely. So I don't think we have to hold our breath for the central banks. They're going to be a while.
No, just to reinforce that, I think that's exactly right. The time range, and you know, there's one or two that will do something this year that's, I would say, real. You know, the Fed, the European Central Bank, Bank of England, this is going to be 5+ years in my estimation. But the rise of stablecoins has been fairly dramatic, I would say, over the last 12 months. There were the early experiments back in 2016, 2017. You know, JPM coin, all the mega banks in Japan all produced something, and it was all within walled gardens. You know, I think USDC, you know, has sort of broken the mold a bit there, and so it has become fairly ubiquitous. But there's people, obviously, you know, the big commercial banks have got a vested interest to try and protect their existing environment. So I think you know, we're seeing more sort of, I would say, neobanks and smaller banks really going fast on stablecoins. I think the commercial bank, the big players, will wake up to it, and they're starting to pay more attention now. So, without naming names, you know, one of the top 3 banks in the US is very actively looking at what they're going to do in that space. And then the central banks will definitely be slower, right? And that's, you know, I don't know whether it's the chicken and the egg, but I think they will eventually get there. I think they have to. But time-wise, yeah, I mean, the action is CBDCs are laying the foundation now. Stablecoins is real.
Thank you, James and Andries. Jan, let's turn to retail CBCDs and talk about how introducing them would affect financial services in Africa, whether it would lead to the emergence of new payment providers or whether it would disintermediate banks?
So listen, I think in today's environment, whatever we think, we are all vulnerable to disruption. That includes banks and everybody else, even central bank we heard earlier today. And there's going to be an unpopular view, I think. I feel if a central bank issues even retail CBDC, I think it's going to do bloody nothing with the payment system. And what I mean by that is I'm not saying that CBDC is not going to happen. It will happen. It will happen because it's the next evolution of money, right? As we moved from gold, silver, metal coins to banknotes, this is the next chapter. This is the next step. We will get probably certain things wrong. We will learn, like the early days of issuing banknotes, it was also done quite differently and not that well. But the problem I have is if SARPS tomorrow issues a CBDC, is it going to change anything for the spaza shop owner? I don't think so. What is going to be the app, he or she will use? So I think CBDC is an important building block. And yes, thank you, Pietro, for mentioning Project Jasper. So yes, that was the first DLT project within the central banking community. I think if we manage the CBDC well, it's going to be an important building block, as I mentioned, but we also have to be careful not to try to make it everything for everyone. Because CBDC should be really next generation of a liability you can hold against the central bank, either as an institution in the wholesale space or as a consumer or businesses in the retail space. But please make it simple. And please open it up as this building block that different players will be able to use differently. And example of the People's Bank of China, right? They have been playing with CBDC since 2014. They have been in this quiet pilot, which for global standards, it's not actually a pilot. It's a real thing with a lot of users, a lot of people. They will probably just say one day, okay, now it's real. It's not a pilot anymore. But they are not trying to make the People's Bank of China eCNY a super app, right? It's not trying to compete with WeChat necessarily or Alipay. It's supposed to be a smart wallet which enables these closed loops. And don't forget, banks are a closed loop, VodaPay is a closed loop and all that stuff, to actually create an environment where people can transact, they can buy their goods and services, and then seamlessly you move the value underneath. And that's the role, I think, even us as a clearinghouse, we will have to get used to, that technically people will hold value in whatever they want, right? I think somebody mentioned that it could be loyalty points. South Africans and many other nations, we love our loyalty points. Why is it so difficult to pay portion of something in loyalty points, something in fiat currency? So anyway, I'm saying I don't think if we continue on this journey that everybody will try to do something in silo, it's going to disrupt actually anything in the broader payments ecosystem. There are some use cases in the wholesale, and I agree that programmable money and removing inefficiencies when you do payment versus delivery, payment versus payment, that's going to be all great. But if we really look at the retail space, I think we need to create a platform where we will all collaborate and come up with different ideas how to make it work. That's my view.
Thank you. Pierre, what is legal tender, and should a retail CBDC become legal tender?
Yeah, what is this thing, and should I even care about it? I think carrying on where Jan left off, if I'm a consumer or a business, I probably couldn't care less whether this thing is legal tender. I will explain now what it is for those who don't. But for me, using a payment instrument is going to be determined by its utility, its ease of use, its accessibility, how ubiquitous it is. That is what's going to determine for me whether I use something, not because it has a particular status as legal tender. I might, as a certain segment of consumer, might not even really care that it's backed by a central bank, for instance, if we're talking about a CBDC in that context. Now, if we talk about what legal tender is, we have to just understand that in a typical legal construct, there's the central bank law and there's the monetary law in a country. And the monetary law is the thing which will describe what the national currency is, the unit of currency, how its value is determined. It will describe a set of 4 or 5 attributes related to how do I know what the nominal value is, what are my privileges in terms of common law, what are the criminal law protection against counterfeiting and that kind of stuff. And one of these attributes is whether it is legal tender. Now, legal tender simply means that because this is the official currency, you are, your monetary obligations you might have to a creditor. If you submit payment in that currency, then by law, you are deemed to have discharged your obligation. Conversely, the creditor should not be able to refuse that. Now, that seems to be a bit of an anomaly because in many instances, people won't accept cash for whatever reasons, cash, cost, inconvenience, safety, that kind of stuff. Now, what different jurisdictions do with this particular concept is up to them. They might decide to apply a rule which says, no, you're not allowed to it, or they might turn a blind eye to it. But that, in essence, is the meaning of legal tender. Now, there are quite a few instances where maybe commercial bank money could be recognized as an official currency or a means of payment, rather, shall I use that word, in terms of the monetary law, without it being legal tender. And usually you would have in a country at least such one currency, which is the official means of payment. Others might adopt others. You might have be a dollar-based as well as euro-based, in addition to your native currency that you use. Now, if we move back to the central bank law kind of space, the central bank law does not determine the monetary law. It provides the mandate for what the central bank is supposed to be doing in terms of executing, not only against that, against its responsibilities in terms of potentially the Constitution and so on. Part of that usually determines that the central bank has been given the mandate and indeed the obligation to issue that national currency. And because it typically has that legal tender connotation, that is why people are saying now when we think about the CBDC to say, but should that also be legal tender? An interesting study paper that the IMF published in 2020, they looked at 171 of the central banks which were at that time registered with him. And of that, 61% what it is that they could issue was restricted to this currency. This national currency. There was no scope for anything else. 16% did not speak about any form of digital currency at all, but there were 23% of those central banks at the time which created the space for digital currencies to be issued. Okay? Now, very few of those actually speak about the ability to issue it as electronic or as an electronic form of legal tender. So what the research is showing is that maybe the point where we're at, because some central banks have since gone their way to say, let us change our legislation to create the opportunity to issue this as legal tender. They might have their particular reasons from a policy point of view. They might want to persist that and say, I want to add that to my collection of national currencies and say that is legal tender, and I have specific reasons for it. Personally, I have a question whether that status is going to make people want to use it or not. I think it is all about the utility and cost and all those sort of wonderful things that I mentioned in the beginning. I think what is clear is that rather than trying to shoehorn the potential issues of a CBDC into existing legislation, it might be better to use this as an opportunity, this disruptive event in our lives, to stand back and say, should we not perhaps relook at how we construct and how we identify these different forms of digital currency, cryptocurrency, from both the monetary law perspective as well as from a central law perspective, so that we can make sure that we identify very ill-defined concepts at this point in time. How do you recognize a token-based CBDC, for instance, in terms of existing central bank law? So the suggestion is, in terms of what research one picks up on this, is perhaps it is time for us to use this as an opportunity to have a look at how we identify and define these different kind of concepts and how we recognize and build them into our legal framework.
Thank you, Pierre. The next question is for you, Pietro.
Yeah.
So privacy is one of the main concerns people have with retail CBDCs. So are there technical ways of ensuring that retail CBDCs have as private as cash?
The short answer is yes, there are. And they are related to the utilization of one of the cryptographic primitives invented by the founder of Algorand, Professor Silvio Micheli, who got the Turing Award for this, and it's the zero-knowledge proof logic. Having said that, though, I would say that the technological answers to many of the issues that have been raised before, and in terms of privacy logics, in terms of interoperability, for instance, exist. But they need to be put in the perspective of what the society or the community we are talking about wants to achieve. We can strike the right balance between many trade-offs via the technological primitives that exist today, for instance, between privacy and traceability, right? They seem to be somehow solved by pure cash, but even banknotes have a serial number, which represent a sort of way to make it traceable, right? And therefore, it's more, let me say, a consensus on the governance of how the design of the system that you want to put in place needs to be implemented that will define all this, right? It is true also when it comes to interoperability logics, not just related to decentralized ledger technologies or blockchains, also related to centralized systems. If I was a libertarian, I would be much more afraid of a global system, a global stable coin with no regulation on top of it, like the original Libra concept, which at the end of the day comes from a centralized type of institution that will gather all the data of the users. What we are advocating here for is probably something different that is more related to the ability of the central bank to play the role of the central bank, the ability of the commercial banks to keep on doing what they are doing and strike the right balances within what needs to be the framework that the society decides overall. Do we want perfect privacy? Yes, it's achievable. Which is the cost of it? Do we want perfect traceability? Yes, it's achievable. In the digital world, by the way, most of the things are pseudonymous. They are not anonymous. They are related to the existence of a user ID and a password, right? So where do we want to find ourselves down the line in 5 years or even 10 years? that's a demand that goes, a question that goes to the governance logic.
Thank you, Pietro. Andries?
I don't have a lot further to add to that. I think it's a very comprehensive answer. Maybe just to make it a bit more practical, you know, for me, on a Friday afternoon, I drive home from work and I like to buy my wife flowers, especially some weeks where, you know, maybe I worked a bit too much. Then I like to go home with the flowers and she's all nice. Most Fridays, if I come with the flowers, then she's quite nice. But the point is, I don't want her to know about that. Okay, so I go to the flower shop and I pay cash. Because if I swipe the card, then she sees the message come on her phone and say, oh, he's bought me flowers, you know, why did he do that? And she has time to think about it. So I want to have cash for that, right? Which is a little bit different to the minister who, you know, some of you may or may not know, but who goes to the watch shop in Sandton City and buys his, mistress very expensive watches now, with cash, because he doesn't want anybody to know about the transaction, right? But that's also okay in my book. Not really. No, it's not okay in my book. What I mean is, economically, it's okay if he got the money through, through a good and proper means. That's still okay. He must have the ability to pay in cash. That's okay. But that's very different to the Guptas taking bazillions out of the country, which they obtained in a way that was not. And so I really liked what Pierre said earlier, that there has to be a line where we don't care, right? If it's under that line, you cannot hurt the economy by buying flowers, or even expensive watches, perhaps, so maybe that's still okay. But when it gets above, but then we're back into this world of almost, exchange control in a sense, so high value payments, low value payments, that sort of. So where do you draw the line, and what is the behavior? Well, I guess that the point is with AI we can get really clever about these things, and so not too clever, because in the end we don't want programmable money. We don't want protocols that gets too smart, and traces everything. I certainly don't want that. But I think that we also live in a world where we have to be responsible about money, and that we have to set, and so I think privacy is solvable. Z case, that's of course zero knowledge proofs. That's done, dusted. There's sufficient ways to do that. But it is important that we have the tough discussions now, because it's not, as we've seen with the pandemic, as soon as bureaucrats get involved, they like to overreach, right? And so I think that we must be very careful when it comes to how we program the financial system of the future, that we leave enough room to buy the wife flowers. That's all I would say.
Thank you.
Or yourself flowers, maybe. Flowers.
James, how can we ensure interoperability between different payment rails?
Yeah, this is a great question, and this is probably an hour's worth of answer. I'll keep it short. Interoperability, let's just define it first. I think it means different things to different people. My view is, when you talk about CBDCs, there's sort of three levels to it. Firstly, you have to interoperate with the existing payment rails, right? There's no point having a wallet with a CBDC if you can't go and buy your coffee or whatever it is you want to spend it on. Then you have sort of interoperability with other currencies. So whether that be cryptos or stable coins, right? So how does that work? And then the third piece is really cross-border. We haven't talked about that much so far, but multi-CBDC or cross-border. So at a technology level, things are operating on the same protocol. It's relatively straightforward. The reality will be there will be multiple protocols be adopted around the world and within countries. So there is work going on. There's some work we're doing at Stanford University in California around looking at sort of super efficient interoperability between protocols. But I think more importantly, if you go up, it's around policy and standards ultimately. Ultimately, and this will take probably longer than central banks rolling out their full CBDCs, but you need to have some standards around interoperability. That will take time. So in the meantime, I think it's going to be there won't be one sort of standard answer. I think there will be rule sets. So, for example, one jurisdiction might have a rule that, if you spend $100 or more, it has to be tracked. And another jurisdiction, it might be $500. So when you're doing a cross-border, how does that get sort of reconciled? So, I think it's a big topic, and it's a multi-layer topic. But ultimately, if you were to get this utopian world of being able to send money or buy things anywhere, anyhow, anywhere around the world, then interoperability, on all levels needs to happen.
Jan, do you have any input?
Yeah, I don't know if I have much more to add. So, well, first of all, I need to buy more flowers. Clearly, it makes my life easier. It will make my life easier. The other topic, besides having life easy, is how to do interoperability, because that's what clearinghouses do. And I am faced with questions quite often, are clearinghouses going to disappear? I don't know, maybe. But what I liked in the previous panel was this debate, can there be one massive ledger which does it all? It's probably unlikely. And I was sitting on W3C for a while, and now I know Adrian is doing something there as well. It's not trivial to find a way how two distributed ledger technologies can talk to each other and become interoperable. So I think for now, what we will have to do, and for me, it's relatively simple, right? We are launching this program called Rapid Payments. It does all kinds of things, but fundamentally later this year, it will put in place a platform which in my mind will enable all kinds of channels, right? Being it an app from VodaPay, as I mentioned, or some other app from another fintech, or a banking app, to reach any store of value which legally people can hold their wealth in. And that could be a CBDC wallet, it could be a bank account, it can be a mobile money wallet. And what we are creating as BankservAfrica is kind of this, call it an orchestration platform, where hopefully in a secure way, because the other thing besides interoperability, we manage risk, we allow people to transact wherever they want in any app, Facebook, platform, whatever it is, from any store of value they actually hold. And it has a lot of implications to verifiable claims or authorization and authentication. So we also are exploring what we can do in that space when it comes to digital identity. But those are things which I believe are not that difficult, right? The example of SnapScan and Zapper, it's not a rocket science, but somehow we still haven't gotten it. So I hope later this year, when we launch the thing we have been up to, the interoperability will become better, and hopefully even the CBDC, when SARP launches, the retail CBDC, can take advantage of some of these things.
Thank you. So the first panel spoke about the risk of banks being disintermediated, and I'd like to know what this panel thinks. We can start with James.
Well, I think as Jan said, everything is got the potential to be disintermediated. I think that it'll be some banks will actually embrace the technology and will lean in and see ways of generating new business for themselves, new business models, and do really well. Others, I think, that are maybe a little bit more conservative, they may miss the boat, right? I mean, I think there's a little bit of debate about first mover advantage and FOMO, right? Fear of missing out by not leaning in. But yeah, there's definitely that scope. There is some big discussion around, if CBDCs become, a bigger percentage of the money supply than central bank money is today, whether that has an impact on banks' ability to do lending, right? I mean, that's another whole big topic. I think it's in the interests of the central banks and governments to provide an environment that's stable, right? And we've seen in the US, it's clear that the Federal Reserve Board and other sort of stakeholders in the US will be working very closely with the major banks to figure out how a CBDC will happen and how it will get implemented. So I don't think there's going to be wide-scale disintermediation, but I think the banks are going to need to lean in and take advantage, and those that sit back and don't, they'll suffer.
Me? Yeah, that's a massive question again, but I think that fundamentally banks should go back to their traditional business model, which is credit creation, which is making good decisions as to who they lend to and who they don't lend to. And I think that if they don't, this technology and everything that's going on, so it's not just CDBC, but it's the opening up of the monetary system to innovation. I think that really challenges the existing banking model, which is making so much money out of ancillary services, which really isn't core to banking. I think banks will go back to being good lenders, good custodians of the credit in which they've been provided, which is a critical function. I always say that I'm actually a conservative person by nature, even though I say some wild things. I believe that if a wall has been erected, you must think very carefully why you break that wall down. And so to just say we're going to disintermediate and disrupt and all of these terms, think very carefully. The world has seen the best times ever in the past, let's say, generation, 2 generations. We've gone from, by any means in which you measure, if you take, just for me, the favorite measuring example is life expectancy. Take life expectancy across the globe, it's jumped up in the past 20 years or so. A massive reason for that has been economic growth and stability and sort of, accessibility of food. And there's a lot of work to do, don't get me wrong. But think very carefully before you break the banks, because access to capital has been a major, major push in terms of the developmental index across the world. So I think banks will change. I think they'll become more, we speak a lot in the decentralized finance world about decentralizing everything. At the end of the day, finance cannot be decentralized. It is one person making a decision based on who they trust. You extend credit based on who you trust. Yes, you can do that to a DAO, but still you have to trust the DAO. You have to understand it, right? Or the other way around. And that cannot go away. Banks are the method in which we do that, and they have an important role to play. So I would not like to see them disintermediate. I would like to see them change fundamentally. And I think it would be banks are worried, the ones that I speak to at least, are very worried about central bank digital currency and the programmability, the programmable nature thereof, actually taking them out of the loop. I think some banks are really concerned about that. And I think that is something that we should debate. That should not happen. There should never be a central, component making decisions to what should be a decentralized system. Banks have a role to play in the decentralization of the credit decision-making process.
No, I probably answered before. So if I was a CEO of a bank, CBDC wouldn't be probably on the top of my list for disruption. I think there are more immediate threats or fears I would have. But I agree with you. I would really focus on what am I expected to do if I have a banking license, what banking is really about. And that's for me, not to lose trust, not to lose the deposits, and be able to multiplicate the money and lend it out. That's what banking is about. So. Yeah.
I think generally speaking, what I see is that central banks, in terms of their considerations around CBDCs, is being very cautious around the topic of perceived disintermediation. Yes, it is a concern voiced by commercial banks, and disintermediation can happen in a number of ways. You could incur. If this instrument that you create as a central bank is perceived as being more robust than having your money in a savings account or whatever at a commercial bank, that could have adverse implications, and you have to be concerned about it. And I think that is the reason why central banks are being so cautious, is to make sure that they understand what these potential implications are. Because I have not yet come across a central bank who says our intent is to disintermediate the commercial bank as a community. Not one. In actual fact, maybe part of the reason why we have this perception that central banks are moving very slow is that they are actually being very careful not to create such situations. I also have not come across a central bank, I can't say not, but generally speaking, central banks understand that they know nothing about retail banking, so they don't want to get involved with it. They don't have the wherewithal. It's not part of their mandate usually. They don't know how to deal with it from an operational point of view. They don't have the skill set to deal with it. So for that reason, I think that, I think what Jan is saying about, CBDC not maybe being the biggest thing that they should be concerned about. But I think it is, I think it's probably a fear that commercial banks have that is understandable. But I do not think that it is one that will realize. I think the central banks are generally speaking very, very careful about that.
I mean, let's look at a very precise document that a central bank has been issuing, and it's the Bank of Israel, right, which is not known to be, particularly, crazy or risk-taking type of institution. They have been doing the analysis of how the issuance of a CBDC would affect the banking intermediation, and they found out that, yes, some of the revenues coming from the ancillary businesses could be impacted, but in any case, this would not turn into a massive disintermediation of the financial system in Israel, at least, right? And I appreciate that not all countries are done the same way, and the financial systems can be different country from country, but their findings were pretty important, and therefore their logic is, okay, there can be an impact in terms of revenues, but it doesn't come from the disintermediation of the logics of the fractional reserve, which is the credit creation that we want, I think, collectively to preserve. And another element is the fact that aside this, which can be definitely addressed via the proper design of the articulation of a central bank digital currency with stable coins, and therefore the commercial bank issued type of means of payments, we need to think of what is the real competition that banks are actually facing. And it's not coming from central banks, it's not coming from blockchain, it's coming from big data. That's where the actual competition to central banks and commercial banks in traditional format is going to come from, right? So I think that overall commercial banks are in a better spot if they somehow bite the bullet when it comes to the ancillary services that a novel infrastructure allows to be performed in a more efficient manner, and then stand in front of what needs to be done appropriately with a banking license within a regulatory framework without the alienation of data that big data tend to bring to. Moreover, these type of systems can be open source type of systems, while big data by definition is a walled garden type of logic, right? So also in order to assess the privacy and accessibility consideration that any infrastructure should think of, well, this is something that we need to take into account.
Thank you, Pietro. We'll move to the Q&A session. Okay, go ahead.
There we go. Just a comment. So James, you said 5% of payments happen in central bank money. I would agree with you in terms of volume of payments, but probably 90% of, Pierre can maybe confirm that, of value is pushed through in central bank money. So Andries, the question is really for you, and I agree with you, once capital markets start issuing instruments that are natively or denominated in these currencies, that'll take off, because then banks can run their risk portfolios, and they would need the liquidity in these new digital currencies. The one thing which we haven't touched on, which I'd like to get maybe your view and maybe some others' view on, is we keep talking about the ledger as if it's a thing that exists amorphously somewhere, but the ledger's got to be run by someone. Someone's got to say, you can run a node, you can run a node. Pierre mentioned this a little bit earlier. We've got to be careful about who we allow to to run those nodes, we've got to be careful about what their role is. Are they just a participant? Are they actually validating the blocks? What is their specific role? What is your thoughts in terms of, you spoke about the ledger and issuing instruments onto the ledger or having cash available on the ledger. What are your thoughts around what that actually looks like? Pick a jurisdiction in South Africa, wherever it is. Because many times we speak to people and they say, well, we'll run all the nodes. And we're like, well, what's the point? So what does that look like in the future? Maybe seeing as 90% of the value is going on in the capital market space, let's stick to the wholesale space, but feel free to digress if you want.
Yeah, great question. I think, and I think we should have a policy against previous panel members not being able to ask difficult questions. I think that, so part of the answer has to be in some form of a delegated proof of stake mechanism where the anchor, some of the blockchains use the term anchor tenant of the infrastructure is vetted in some way, and whether that's through a staking contribution or through a financial or through a voting mechanism. I think that's really important because I would say this, in the capital market specifically, there's a lot of fuzzy terms that goes around democratization of finance and all of this stuff, and that's fantastic, but that's really not very helpful in the capital markets. Capital markets is a big boy world, and if that sounds big boyish, then trust me, I always almost just also try and play in it. It's a world where you have to know that if you get it wrong, you get it seriously wrong. So you don't democratize that. You don't just get to play. You don't just pitch up and say, "Oh, I want to play. Throw me the ball." No. There's some serious consequences if you get it wrong, and therefore it is a world that there has to be a set of rules, and there has to be a set of criteria to which you have to conform, or not conform, but at least to play. There's a ticket to entry, and so the same should be for the infrastructure that governs the way in which we interact. Absolutely, so where Bitcoin could be this, in your words, I think you said mess of, de mekaar spul, of who knows who, and that's okay for Bitcoin, and it's worked out because the structure is fundamentally sound. But that can't be the same for capital markets, So I mean to say that I think I don't think R3 is the answer, but I do think that, and I think that it has to be, it should be much easier to get access. I think access must be cheaper. I think the opaque nature of pricing at the moment is problematic in the capital markets, and if one can sort of cut down on those requirements and on those problems, then that should naturally follow to who can host infrastructure, which should be, if you, difficult question, but if you think about high frequency trading, you're really thinking about massive infrastructures that are there to crunch numbers as quickly as possible and as close to the origin as possible, right? So that implies high cost. Even with Moore's law still working, it will imply high cost for a while to come, but still, it should be possible for a small player to also be an anchor in this network in order to have access. And so, basically, what I'm proposing is that the ticket to play should not be a club. It cannot be something like straight, or the JSE where where there's it cannot be that, but still there has to be a sort of a sizable ticket to play, which would in turn imply a good actor and a strong player. So that would be my answer. But I think it is critical that we do see the power of having delivery versus payment and the ledger acting as custodian to the world, and multiple ledgers at that. I think that goes without saying.
Yeah, I think multiple ledgers is the key here. I think this question is a great question and a difficult one, but yeah, a lot of the central banks are starting to think about these design features. There's some models emerging where the central bank holds like basically a centralized ledger that has all the relative information that the commercial banks have. So that's the sort of wholesale piece. And then as an example, each commercial bank could hold their own ledger for their own network of clients, and you have interoperability between them. So there's some different sort of multi-ledger ideas knocking around. I definitely don't think there'd be like just one big master ledger. That kind of defeats the object, right? You really want to have as much distribution as possible. And then you start thinking about, allowing other entrants access to the central bank that haven't had before. So, for example, fintechs, will they be allowed to have accounts at central banks? So, it's an ongoing question, and I think the conservative people just want to sort of do it the same way it is done today, but a little bit more efficiently. And the more adventurous people are saying, no, we should allow startup banks or fintechs to have access, and but they're not necessarily going to have full access to what the central banks see. So this nets into the whole discussion around privacy and identity. It all sort of pulls together. So a really difficult question, but a good one.
Yeah, there's a lot of trade-offs in this whole discussion. Right. Like the trade-offs between the intermediated model, if you talk about the BIS models that you just mentioned, which implies a trust by the consumer on his service provider versus the single ledger model, which has other trade-offs again. But the point that I want to agree with very, very strongly is that I struggle with the concept of democratizing governance in a system of that nature, especially a high focus or a high value system like the one that you spoke about now, the capital markets. The different stakeholders take different positions of risk, have different responsibilities. Okay? So the kind of challenges that we have today in constructing schemes and scheme rules, I'm still trying to wrap my mind around how you can construct. Yes, the tech is there to have voting stakes that get allocated. So we're not talking about the tech here. I'm talking about how you construct that scheme. If it's a CBDC, who's the owner? If I'm as a central bank backing that, I want to have a serious say in what the rules like that get defined in there. Maybe there's certain of the operational aspects that I would be happy get decided on a more democratic basis. And yes, let us pursue the inclusion or broadening participation, rather, maybe to use that term. But I struggle to see how one can achieve full-on democratization of a governance system of that nature. There are specific roles that different stakeholders play, and I can't see how that can disappear. Maybe I'm just very slow in my grasp of this, but I struggle to see how you're going to do that.
I think we can have two more quick questions.
Thank you. Thank you. Just to explain my cynicism, perhaps I should say where I come from. I'm a lawyer at the law firm ENS Africa, and we have done quite a lot of work, funnily enough, for the IFWG and in the background for looking at the CBDC. But just to place myself in context. Now, I think everyone is aware of a kind of backpedaling. Perhaps that's too strong a word, but taking one's foot off the gas, perhaps, as far as the US and the UK is concerned. And the questions are now being asked. What problem are we really solving for with the CBDC? So to narrow that question somewhat, I really would be grateful if someone can give me some information or share their thinking with me as to how a CBDC is really going to solve financial inclusion in particular. And I take the point that a CBDC shouldn't be everything to everybody, and it's not going to solve the problems of the spaza shop owners. But despite my having read really widely around this, I just can't see how it will solve financial inclusion, particularly looking at the KYC requirements, which are going to obtain forever, and accepting that we just, so many people just have no means of identity, leaving aside, the risk-based approach. So if anyone can shed light on that question or give me some kind of answer, I'd be really grateful. Thank you.
One person can quickly answer that.
I'll have a shot at it. I think the identity piece is the KYC is complicated, so to put that to one side for a second. But I think the potential, whether it's a CBDC or some other form of digital currency, is to be able to provide services at a much lower cost point. If you look at what's going on in Brazil, for example, there's a massive percentage of the population that doesn't really have access to financial services in the traditional sense. And despite multiple efforts over multiple years, the commercial banks, who are profit makers, have not been able to find an economic way to offer, services to people that have a very low income. So, part of the equation, I think, is purely the economics, right? If a central bank provides a core platform for CBDC and allows the private sector to innovate on top of that, there's the potential to have, fintechs coming in with very, very, very low cost services. So I think that's part of it. Then you have to think about the identity side in terms of how much services or lending can you offer when you don't have any history, right? And I know there are lots of projects around the world looking at ways to get a view on someone's creditworthiness without traditional credit scoring. But to me, the cost piece is the potential. I don't know if that, you're nodding a little bit there. I don't know if you agree with that, Elga.
Sorry, I know other people have questions, but just my response to that, and I think, of course, that's a compelling argument and a completely satisfactory answer. But, if you have a look, and I can only speak for South Africa, we have a number of banks which, their main competitive edge, mainly the challenger banks or the neo-banks or real tier 1 banks, they really are going in at a zero cost or a very reduced cost structure. So aren't there other things that we can solve to meet that objective before we say the CBDC will assist or ameliorate people not having access to banks? But I understand it's a bigger debate.
Well, we could maybe chat about it at the break.
Sure.
But we can, if we can respond to I'm sure Jan has got a few comments about that. But if you look at the reasons why central banks look at CBDC, and I'm talking at the retail level, just generally, it really depends which central bank you're asking. And so one thing that is coming out in international studies and the papers that various central banks issue is that, and the BIS research papers, is that every jurisdiction, every central bank is going to have to figure that out for himself. Because it depends where on the developmental curve a jurisdiction might find itself. Okay? For some central banks, financial inclusion is very important. They see this as an instrument which can help them maybe leverage certain services off. Okay? For others, they might want to reduce the usage of cash. Others might look at it as to say, oh, we're not so sure, but we better be prepared. So let's have a look at this. So in case something happens that disrupts things so much, and we need to take action, that we don't get caught unawares. Others might decide that, we don't have a financial inclusion or a payment systems modernization objective because there's enough other initiatives going on that does that, such as the RPP that Jan mentioned just now. But maybe what we need to consider here is that we have a policy stance which says, if cash disappears over the next number of decades, do we want to be in a position to offer a public form of digital money Or are we happy to leave it all in private hands? So I think I've given you kind of probably the 90% kind of general reasons why central banks are investigating the CBDC. And the bottom line still remains that it will probably be different for every jurisdiction. There's not a magic solution for everybody which says, well, here's a wonderful tool. So yes, in the UK, the House of Lords asked the question and said, what problem are you trying to solve? I mean, the BAE team is trying to figure that out by going to their stakeholder community and say, guys, what is it that you're thinking?
Last question.
So I have a bit of an issue with the polarity of the definitions retail and wholesale. It's been touched on a few times. On the one end, we talk about huge volumes and low values, and on the other, low volumes, high values, but not a lot of consideration for the middle, which I think most economists would argue is where most of the growth comes in an economy, small to medium-sized businesses. So I'm interested to hear from the panel what type of CBDC best benefits small and medium-sized businesses. What problems are you solving for them? The guy who's going to move from cash to digital cash at the spaza shop, I don't think is adding huge amount of economic growth versus the huge corporations on the other end, you know, who now have access to central bank money, which maybe they didn't have before. What form of CBDC is best going to benefit the growth engines of an economy, the small to medium-sized businesses?
Well, if I can take a quick stab at that, okay, and then I'll very happily give it over to somebody else. Okay. If we think about high value, I think, I forget whether it was James who expanded earlier. In today's terms in South Africa, high value is, what is it?
5 million.
5 million. So any payment greater than 5 million has to go through, is regarded as a high value payment and has to be settled in the RTGS and so on. Everything else is therefore deemed low value. That is just the classification between the two. So your wholesale CBDC looks at that space where you're talking about interaction between banks. It's interbank flows, okay? Whereas your retail CBDC is the thing which is going to energize and be useful in that medium sector, or even corporate and medium and smaller sectors. Now, if we understand in South Africa where we think our growth is going to come from in future, that's exactly the market that we should be going for, is to enable and support that, provide people with better access to financial services, payment instruments, things of that nature, make things better for them, easier for them to transact with. So to answer your question, that's where I believe the growth is going to be.
If I may, I think it's an insightful question, but I don't think this is about CDBC. To me, CDBC is just another form of fiat, right?
Correct.
It's just got different rails. What we are concerning ourselves with here is the complete overhaul of the financial system to a trustless, decentralized mechanism, you know, of a ledger which promises so much and which we really are only in the first 10 years of innovation on. So what does that mean for the small and medium sort of business owner? Well, I would like to suggest that if you own a small and medium business, as I certainly have, you have a lot of challenges, you know, to gain access to that market at that time that you actually need access to. And so the promise is that you should have greater access to capital, whether that's in the form of you know, equity or in the form of debt. And that capital should be easier to arrive to your door, because the problem at the moment is, I don't know if anybody here has been through a capital raising exercise, but you go through an exercise called the due diligence, which is extremely painful. Now, CDBC will not end the due diligence, but it will certainly ease the pain. It will certainly ease the program. It will certainly give you access to, and access is the key term, to a much larger base of investors working off a singular hymn sheet, if you like. I don't think CDBC makes any difference. Maybe you can make a payment faster. That's certainly difficult, but that's typically induced by exchange control in this country, at least. You know, so if you need to make a foreign payment, that's very difficult often because you need to fill out 500 forms. You know, trying to explain to someone that this one is actually not a category 7C, it's a category 7B4. You know, something like that, which is ridiculous. But I think that what we are busying ourselves with is the fundamental change of the financial system, and that will certainly hold massive benefits, the way I see it, to the small and medium enterprise. I can think of other examples, but maybe over lunch is better. Yeah.
If I may, I would try to answer to this starting from the idea that somehow growth comes from discomfort, right? And somehow it's true here as well. Personally, I believe that CBDC can play a role in being conducive to the adoption of digital processes. Can be helpful in the adoption of those digital processes that will eventually increase the productivity also in small, medium enterprises. There is a clear link between ability to innovate and adopt innovation and growth. And I personally see CBDC as a form of money, not the only one, but one of the forms of money that can be conducive to this digital economy. Hence, this growth shared with small, medium enterprises as well.
Thank you. Unfortunately, we have to end there. We are 20 minutes past. But thank you to all our panelists, Pierre, Durandt, Ian Pilbauer, Andries Brink, James Wallis, and Pietro Grassano. Thank you very much for your time and input. And I will call Pierre.
Let's give everybody a hand. All right. Thank you very much, Carlos. Thank you to all the panelists. I'm really happy that we had a bit more of a controversial discussion than this morning, where sort of the consensus was much easier to reach than among this group. It's really an exciting time to be organizing these events, and I'm grateful to everybody who came and who made this happen. I would also like to thank in particular Ripple for supporting the University of Cape Town through the UBRI. Some of the students that actually have bursaries are here today, and so if you're one of them, you should let James know sort of what you're working on to make sure that the money is well spent and Ripple knows about it. I would also like to thank the South African Reserve Bank for sponsoring the chair that I hold at UCT, as well as the Algorand Foundation for setting up the Algorand Center of Excellence here at the University of Cape Town. We were the first. The others will be revealed soon, but it's a very illustrious group, and we are very proud that we are part of this. So what we want to do now and going forward is to position Cape Town really on the forefront of this technological innovation that is challenging the banking system. I think that is the part where everybody agrees that there is a technological shift that is happening now that can actually push the envelope of where we are today. What it is, where we are going, and what we are building. I think that indeed that is not so clear. And this question of why do we need a CBDC that I know I have on good authority has the retail CBDC project in South Africa discussed at length and several times. And I think it's important to always ask that. So one of the things that I take out of this event today is that we probably should have another event in July, which we do from the other side. We do it as a grassroots event, where we invite some spaza shop owners, where we invite people that would be directly affected and that we can think of, that they might be the ones that actually would benefit the most. And we ask them, like, if this was to change that was happening, what would it do to your life? Would it do anything at all? Would it change how you process payments? Would it change how you do business? And we sort of look into this topic from a somewhat broader perspective than what we could start in a single day, on a single morning. with that being said, I'm really grateful to all the participants, and I also want to give a special shout out and thanks to Anna and to Lindy for organizing everything. So before we go for lunch, exactly. I was about to say, please join me in thanking them, but I got overtaken by events. So without any further ado, please join us for lunch. Thank you everybody for coming.